Hello everyone. So in this video I'm going to start our discussion on capital structure, which is module 4. Now, what is capital structure? This is best illustrated using a balance sheet. So if you take a typical balance sheet, you know that you have assets on the left hand side, and on the right hand side you have debt and equity. Now, of course, debt can take different forms. You can have short-term debt, you can have long-term debt. Equity can also take different forms like preferred stock, common stock. And capital structure essentially refers to the right-hand side of the balance sheet. In other words, how is capital structured? Left-hand side is more about the assets. Which assets are we investing in? And if you think about it, a lot of our discussion has mostly focused on the left-hand side of the balance sheet. We've been talking about a financial manager, thinking about, if I'm considering making an investment in a particular asset, what are the financial cash flows that are going to be generated from that particular investment? What is the NPV and all of that? And capital structure has played a role in the sense that if you have a certain amount of debt denoted by the symbol B, and if you have a certain amount of equity denoted by the symbol S, we know that capital structure has implications for NPV in the sense that when we discount the financial cash flows that are generated or are expected to be generated by the assets, we discount them at the weighted average cost of capital, which is calculated as B over B plus S into the expected return on debt into 1 minus the tax rate plus S over B plus S into the expected return on equity. And so, if you have more debt in relation to more equity, that can have implications for the debt ratio and the equity ratio. And actually, indebtedness can also have an impact on the rate of return that equity holders require. And all of that we've talked about in the previous module and sort of considered its implication for the net present value of an investment. The point being that a lot of our discussion has mostly focused on the left-hand side of the balance sheet, but the question of capital structure is that how should capital be structured? Knowing or recognizing that if capital structure changes, it can have potentially an impact on the weighted average cost of capital, right? Because the ratios here will change, the cost of equity can change, even the cost of debt can change. And so when we ask the question of capital structure, the fundamental question is, how should capital be structured? Should we have more long-term debt versus short-term debt? Actually, this is a nice article that I found. Companies issue new bonds to pay down short-term debt amid pandemic. When the pandemic had hit, a lot of companies were actually struggling with liquidity, and they had taken short-term debt. And as the COVID subsided, more firms, this article argues, are now taking on long-term debt to pay down some of the short-term debt. Well, this has implications on how the right-hand side of the balance sheet is structured, how capital is structured. But what is the ultimate goal? The ultimate goal, or the ultimate question of capital structure, is that, look, how can we structure our capital in an optimal manner? What I mean by that is, is there a specific debt to equity ratio that we should target? Go back to the Midland Energy case. Do you remember that in the Midland Energy case, Midland Energy had a certain capital structure, certain debt to equity ratio, but then it was moving towards a target. A more fundamental question to ask is, why would you want to move from a current ratio or a current debt ratio to a target one? Is there something about the target that makes it better? Why would firms want to structure their capital differently? And ultimately, what this boils down to is this question: does the manner in which a project or investment is financed, does that have implications towards its worth? What I mean by that is this: if you go back to the slide, we just talked about this. We said, look, WACC is calculated as, well, using this formula. And depending on how capital is structured, you can have different proportions here. And the cost of equity can be different. And therefore, a WACC can potentially be different, right? And if the WACC can potentially be different, the NPV of the investment can be different as well, because that's the rate at which we discount our cash flows. And a natural question to ask is that is it possible that we can structure our capital in a way so that the weighted average cost of capital is reduced, ideally minimized, because as you can see, NPV is taking expected financial cash flows and then discounting them at like the 1 plus the weighted average cost of capital. And you can do this for cash flows going forward as well. One way of achieving higher NPV of an investment is invest in projects which are expected to generate higher cash flows. Yeah, that's fine. But an alternative way of thinking about it is, well, given a particular investment which has a certain amount of cash flows, can we structure the capital on the right-hand side differently so that our weighted average cost of capital is minimized, and as a result, our NPV is higher? And so that is fundamentally the question of capital structure. If you are at a current debt ratio, is there a target one where if you move towards that target, it results in a lower weighted average cost of capital and hence increases the market value of your assets, or the NPV of the assets that you're about to invest in? Another way of saying this is that, is it possible that the NPV of an investment is negative if you finance it entirely with equity, but it's positive if you finance it mostly with debt? Is that even possible? Because if that is the case, then what we're really saying is that changing the right-hand side of the balance sheet, which is the capital structure, that can change the NPV of an investment. And if that's the case, then what we really want to find out is that, is there a point where the NPV is maxed by changing the capital structure? In other words, can we change the capital structure to minimize WACC? And so this is a very, very important point. What we're really interested in finding out is that, is there an optimal capital structure? I'll label that as debt to equity. Is there an optimal out there? Optimal in what way? Such that WACC, or weighted average cost of capital, is minimized, so min, which is the same thing as saying that the NPV of the investment is higher, or more specifically, maximized. When we're talking about an individual investment, like when we're talking about making an investment in a specific project and discounting it at its WACC, then we're talking about NPV. But if you're talking about the firm as a whole, its assets overall, then we'd be talking about the value of its existing assets. So value of existing assets, where we're saying, look, we're not investing in additional assets. We have a given amount of assets, and what we're interested in finding out is, can we change capital structure? In other words, is there some optimal such that the cost of capital is minimized so that the value of the same existing assets generating the exact same cash flows is maximized? If that is the case, then we want to find out, right, what that optimal capital structure is. And so that is ultimately the question of capital structure. Can capital structure decisions create value? All right, so in order to answer this question, what we're going to do is we're going to consider a very, very specific sort of a situation. I refer to this as an example of a pure capital structure decision, which is basically a debt-financed stock repurchase, or a debt-financed stock buyback. What I mean by that is this. Imagine that there is a firm which had a bunch of assets, and let's suppose those assets were entirely funded with equity. And right, so this was an entirely equity finance firm. And now let's suppose that the firm goes out there and it borrows some money. So it takes on some debt. All right, so debt goes up, but it does not use this debt to invest in additional assets. Rather, it uses that debt to repurchase some of the equity, so that as this debt goes up, equity goes down. The reason why this is a pure capital structure decision, because notice that as a result of doing this, nothing has really changed on the left-hand side of the balance sheet. It's the exact same assets, resulting in the exact same financial cash flow. All that you've done is really changed how the assets are funded. This is not any different from refinancing your mortgage, right? So imagine this asset was a house. You were living in a house, and let's suppose hypothetically that you had no debt, right? So let's get more specific. Let's suppose that this was a house that is an investment property for you, and you have funded it entirely with equity. And now you go to a bank and you say, hey, can you please give me a loan? And I'm going to use that loan to cash out on some of the equity that I have in this house. So all that you're really doing is that borrowing some money to buy back some of your equity. You're basically going to borrow, let's say, $200,000 and basically, take that home with you, which means that now technically you have $200,000 less equity in the house, because you owe that money, but it's the same house. The main point is that the house hasn't changed, your tenant hasn't changed, the cash flows that this house is generating hasn't changed. But the question that we want to ask is that as a result of this change in capital structure, is it possible that the same house is now more valuable or less valuable? Is that even possible? Because then you're saying, then capital structure matters for valuation. So we want to consider this sort of a situation, which is a pure capital structure decision where nothing is happening to the assets and all that we're really changing is the right-hand side of the balance sheet. So in a stock repurchase, the firm is buying back some of the shares outstanding. Now, some of you may be saying, wait, do I need to raise debt or borrow money to buy back the equity? What if I just have any excess cash that is lying around? In other words, I have some let's say operating assets, and then I have some excess cash lying around. Can't I just use, like if I had some excess cash lying around, couldn't I just use this excess cash to buy out some of the equity? Do I have to borrow money to buy out some of the equity? No, but we can easily incorporate this sort of a situation. Think of debt as not debt, but debt minus excess cash. In fact, in finance, we refer to this as a firm's net debt position. Net debt is basically debt net of excess cash. So when I say that the firm is issuing debt, in a way I'm talking about net debt. And net debt can go up in two ways. One, obviously, if the firm is actually increasing its actual indebtedness, which is borrowing money. But the second is by reducing the amount of excess cash that it has. So saying that the firm is buying back equity using cash is not any different from saying that the firm is sort of borrowing money to do it, in the sense that both have the impact of increasing a firm's net debt position. You don't have to worry about it too much at this point, but this idea of net debt is an important one, and we'll come back to it in later in this module, and actually in subsequent modules as well. So here's the question that we're asking: should the enterprise value and hence the stock price increase as a result of this pure capital structure decision? So in order to make it a little bit more concrete, let's use some numbers. So let's consider the following situation. Let's suppose that there is an all-equity firm that is contemplating a debt-financed repurchase. And by the way, I'm going to be assuming for the time being that there are zero taxes. This is actually very, very important. I'll come back to this. So let's suppose, like I said to you before, let's suppose there is a firm which is all equity, and this is a firm that is considering taking on debt, but right now it's all equity. Specifically, it has $8,000 worth of assets, and it has zero debt right now. So currently it has zero debt. So the value of its assets is exactly equal to the worth of its equity, which is 8,000. Interest rate is 10%, but that doesn't really matter because the firm has no debt right now. The market value per share right now is $20 per share. So each of its shares is right now trading at $20, and there are 400 shares outstanding. So notice that 20 times 400 is exactly $8,000, which is the worth of the assets right now and the worth of the equity right now. Now, suppose I am the financial manager of this company. You are my shareholders, and I come to you with the following proposition. I say, hey guys, this is what I'm thinking. I'm thinking of borrowing $4,000, okay? And use that $4,000 to buy back some of the equity. Specifically, I'm going to buy back some of your shares. More specifically, with $4,000, given that each share is trading at $20 per share, I'm basically proposing that I buy back 200 of your shares. So 200 shares will be repurchased, and as a result, the total number of shares outstanding, which will be 200 also. Notice this 200 is different from this 200. This is the 200 that shares that is being repurchased, whereas this 200 is basically however much were there before, which is 400, minus the 200 that is being repurchased. So the shares outstanding will also be 200, which is this guy. Notice that 20 times 200 is $4,000. So that would be the worth of the equity at that point, and there will be $4,000 worth of debt. As a result, the assets will be worth $8,000. And so the question that I'm asking you, the shareholders, is it okay if I do that? And I guess a bigger question that you need to ask yourselves is that, well, in which case are we better off or worse off as the owners of this company? Does the value of the firm go up? Does the value of the firm go down as a result? More specifically, does the stock price go up or the stock price go down? And if you're asking yourself this question, actually looking back at these numbers might perplex you a little bit, because if you notice that as I'm going from the current capital structure of all equity to what I'm proposing, which is part debt, part equity, notice that the share price hasn't really changed. I was assuming that share price will be $20 here, and I am saying that even when we go to the proposed capital structure, the price will be the same. And for that reason, the worth of the assets is also 8,000 here and 8,000 here. If you're paying attention, you're like, then how does it matter? In fact, it seems like you've sort of answered the question before even asking it, right? Rather than you as a shareholder saying that whether the stock price will go up or down, I've sort of already said in a way that nothing's going to happen to the stock price. Yes, if you made that observation, that's actually very smart, very astute. There's a reason why I've done it. Bear with me, this will become clearer in just a minute. But if you didn't go that far and you were like, I don't know whether I prefer the firm being all equity or whether I want it to be part debt, part equity, I, the financial manager, come to the rescue and say, well, let me explain how that would change things for you. Okay, so let me give the same proposition a little bit more clarity. Right now, as we are an all equity firm, okay, next year we could be going into a recession, or we can expect some normal state of the economy, or next year we could be experiencing some expansion. If a recession happens, then the return on our assets is going to be 5%. The expected is 15%, but if we go in an expansion sort of a scenario, then the return on assets will be 25%. Please recall how we measure return on assets. Return on assets is not net income over assets. It's earnings before interest and taxes divided by assets. Remember that, right? This is going back to our very, very first module. We talked about it. In a recession, we're saying that this number is going to be 5%. Now, this is me, the financial manager, trying to explain the situation a little bit more to you. And I'm saying, look, shareholders, here's the thing. Right now, we are an all-equity firm. Next year, our return on assets can be either 5, 15, or 25%. If that happens, recall that our assets are worth $8,000. And so if our return on assets is going to be 5%, then 5%, if you have 8,000 here in the denominators, then 5% of 8,000, that's going to be our earnings, $400, right? So 5% times 8,000, 400. This is going to be our earnings before interest and taxes. If it's 15%, then it's going to be 15% times 8,000, or 25% times 8,000. So 1,200 to 2,000. And here's the thing. Because there are no taxes, and because there is also no interest, EBIT, first of all, because there is no interest, earnings before interest and taxes is the same as earnings before taxes, right? Because the interest is 0. And this is actually the same as earnings after taxes, because taxes are 0 as well. So basically, this is the same as net income right now, in this case. And if somebody asks you what is going to be the return on equity, well, in this case, return on equity will also be the return on assets, because net income over assets is the same as EBIT over assets. And assets, by the way, all assets are funded with equity. So in this case, EBIT, in this particular case, in all equity financing, EBIT over assets is going to be the same thing as net income over equity, because as I just showed you, EBIT is going to be the same as net income, and assets are by definition equal to equity as well, because there is no debt. And so no surprises that return on equity is also 5%, 15%, 25%. And last but not the least, earnings per share. If somebody asks, if you are the shareholder and you're like, okay, so in this situation next year, what will my earnings per share look like? You're like, well, earnings are going to be $400 in a recession. And guess what? Right now there are 400 shares outstanding, which means that 400 divided by 400 is 1, 1,200 divided by 400 is 3, 2,000 divided by 400 is 5. All this to say, if I'm talking to you as a financial manager, you're the shareholder, I'll be saying, look, shareholders, next year, if we remain an all-equity firm, you can either expect earnings per share of $1, $3, or $5. Okay, so this is the variation. Like, okay, and then your next question is, well, how does this change if we now go from all equity to part debt, part equity? If we go through that capital structure change? I'm glad you asked, because notice that if we do that, return on assets is not going to change, because what does debt do? Debt really changes the amount of interest expense that you'll be changing. Guess what? Return on assets is EBIT over assets, isn't it? So earnings before interest and taxes. No impact on this as a result of change in capital structure, right? Because this is before interest. So if return on assets is going to be 5%, 15%, 25%, our earnings before taxes, or rather earnings before interest and taxes, is going to be 400, 1,200, 2,000. However, now, shareholder, the thing is that we will need to pay interest, and then you will get some money back. How much is going to be the interest? That's $400. Where is that coming from? Recall that interest rate is 10%, right here, 10%, and the debt is $4,000. So 10% of $4,000, that's $400. And well, interest expense doesn't really care whether it's a recession expected or expansion. It says, well, show me the money. And so interest expense is the same, which means that what the equity holders will get after interest is either $0, $800, or $1,600, just $400 less. However, the nice thing is that now less of their equity is at stake, right? Because that debt has been used to buy back some of their equity. If in this example, there will only be 200 shares outstanding, right? Because we argued that 200 shares are being repurchased. If somebody asks, well, what is going to be the earnings per share from my perspective as a shareholder? You'll say, well, 0 divided by 200, that's 0. 800 divided by 200, which is 4. And 1,600 divided by 200, which is 8. So all this to say that I, as a financial manager, will tell you shareholders that, look, if we remain an all-equity firm, then next year, your earnings per share is either going to be 1, 3, or 5, or it's going to be, if we go to some debt, some equity, it's going to be 0, 4, or 8. Now, shareholders, which one do you like more? So pause here and think about it a little bit. Do you prefer one over the other? Now, some of you, after some deliberation, may have said, well, I think I like this because if this 0 weren't here, then 4 is better than 3 and 8 is better than 5. But then, well, that's assuming the 0 weren't here. But the 0 is here, and this 0 is less than 1. And what we really notice is, if you think about it, is that here there is less volatility, right? Earnings per share for shareholders is between 1, 3, and 5. Here it varies between 0, 4, and 8. Yes, expected value, like if recession, expected, and expansion were equally likely, on average you're expecting 3 here, and on average you're expecting 4 here, and 4 is higher than 3, but the riskiness or volatility around this 4 is more, right? And therefore it's not as straightforward, but because what we really want to understand is that yeah, our expected return with debt is higher, but so is the risk. And by the way, this is not a radical concept. We have talked about it. Leverage increases the risk to the equity holders. You can see that vis-a-vis this increased volatility. However, this example also illustrates that the return also goes up. A good question to ask, and this is the most important question that I wanted to get to in this exercise, is that, is the additional risk worth the reward? If the reward or the expected reward is more than the expected risk, well, in that case, shareholders will say, I like this situation more. And therefore, the stock price will go up, the value of the firm will go up. On the other hand, if the extra return is not worth the risk, well, then in that case, the value should go down, right? And so the question really is, how does the increase in expected return for equity holders compare to the additional risk that debt is going to introduce? And so this is what I say in the next few slides, right? Main point is leverage is creating risk for the shareholders. But high risk is also associated with high potential return. So the question is, okay, so then which capital structure is creating more value for the shareholders? Which is a different way of saying, in which case is risk commensurate with the expected return? And this is where two very famous financial economists came along and they said, well, what if I told you that it's neither nor? In other words, what if I told you that as you go from being an all equity firm to part debt, part equity, the extra return is exactly offsetting the added risk, so that the shareholders are going to be indifferent between the two. And that is what two very famous financial economists, their names, I'm sure you've heard of them, Modigliani and Miller, they basically showed that under a certain set of restrictive conditions, actually, they basically made this proposition. Value of the levered firm is equal to the value of the unlevered firm. They basically showed that under a certain set of conditions, one of them being that if taxes are 0, capital structure does not matter. You could be an all equity firm, in which case the value of your firm, we'll call it VU. In our case, that was $8,000, right? Value of the unlevered firm. They said that whatever is that value, even if you introduce capital, even if you introduce debt, which was our proposed capital structure, where we were going to take part debt, part equity, as you become levered, that valuation is going to be the same as the value of the unlevered firm. Value doesn't change. And this is a very, very important point, because the moment you're saying this, you're essentially saying that capital structure, when it changes, it does not change weighted average cost of capital. WACC doesn't change. WACC doesn't change. So even if you go from having some equity to part debt, part equity, change in capital structure does not result in a change in value. The only way that is possible, like, think about it, right? Think about it. And this is, I'm going to come back to this point in just a minute. you have some assets, right? And they are expected to generate some financial cash flows, so expected financial cash flows. When you were all equity, if somebody asked you, what is your cost of capital? You would have said, well, actually, it's all equity firm, so it's the cost of equity, right? There is no debt. So whatever is this cost of equity. So expected return on equity. So you would have done CAPM, so risk-free rate plus beta, the whole spiel, right? You had cost of equity. We're saying that as you're going to take on debt, right? So you're going to go from being an unlevered firm to becoming you're going to go from being an unlevered firm to becoming a levered firm. We're saying, well, clearly the financial cash flows haven't changed. And what you're saying is that value is the same. Value doesn't change. But what is value? Value of the levered firm is these cash flows now discounted at the overall weighted average cost of capital. Well, what we're really saying is that if the financial cash flows haven't changed, which obviously they haven't because assets are still the same, and if this number is also not changing because you're saying, well, value of the levered firm is the same as the value that was before, these cash flows are discounted. Like, how does this value number come about? It comes about when we discount cash flows at the cost of capital. And what we're saying is that this number at the bottom, whatever this WACC is, this WACC must not have changed either, which is why you're coming with the same value number. Basically, WACC doesn't change as a result of capital structure, so that value doesn't change. And so this is Modigliani-Miller proposition number 1. Now, how they showed it mathematically, again, I'm not going to bore you with that, but the intuition behind their famous proposition, MM1 as it is called, was simply this. They said, look, imagine that you are ordering a pizza, okay? You call Domino's and you say, I'd like a pizza, please, and, I'd like meat and cheese and, pineapple, if that's your thing. And the guy says, okay, it's $20. And you're like, okay, fine, I'll pay the $20. But as you're about to hang up the phone, the person taking your order says, well, actually, it's $20 if you want it in 4 slices. If you'd like it in 6 slices, that's $22. And if you'd like it in 8 slices, it's $25. How do you respond to that? Well, if you're like most people, you'll say, yeah, I think I have a knife at home. Don't worry about it. Just get me the pizza for $20 in 4 slices. I can cut it myself. I don't need to pay you $2 or $5 extra to cut it. And that is exactly what Modigliani-Miller are saying, if you think about it. And this is very, very important. What they're really saying is that, look, just like what gives value to the pizza is the meat, the cheese, the pineapple, or whatever ingredients you have on top of it, just like that, what gives value to a firm's assets, what gives value to the firm's assets are the financial cash flows that those assets are expected to generate. What capital structure really does is simply change how those cash flows are going to be distributed. Much like this example was illustrating how the pizza was getting cut into different slices. Cutting pizza into different slices is the same cash flows just being cut into different pieces. Well, cutting it into different pieces shouldn't really make the assets more or less valuable, right? Capital structure is more like cutting the pizza, but what gives value to the pizza are the ingredients, much like what gives value to the firm and the assets are the expected financial cash flows, which is why they were saying that the value of the levered firm would be the same as the value of the unlevered firm. This is known as MM1, and this is also tantamount to saying is that capital structure does not matter. It's a radical idea, at least at the time that they came up with it, because what they were really saying is you could fund an investment with 80% debt, 90% debt, 50% debt, 10% debt, no debt, doesn't matter. your assets are going to be just as valuable. In other words, there should be no reason for anybody to think about whether I should fund an investment with debt versus equity. I mean, that's a radical idea at the time. And, you know, they got, I wouldn't say they got a lot of heat, but certainly it's like, well, how can you say that? Well, we said, well, to be fair, actually, we're making a bunch of assumptions. One of them, of course, is that there's no corporate tax, which obviously is not the case in the real world. They also assume that there's no costs of financial distress. We'll talk about it. They also assumed a world in which there are no information asymmetries. Information asymmetry refers to when one party to a transaction has more information than the other. They assume that everybody has the same information. We live in a world in which everybody has the same information. Yeah, that's not true, right? You have information, some information that I don't, and I have some information that you don't. But that's not the world that they were living in, or at least we're assuming. There were a bunch of other assumptions that they made. So they said that in this sort of a world, capital structure does not matter. And they were quick to realize that this assumption in particular of zero taxes was not a realistic one. So they later on relaxed this assumption, and we're going to do the same. They relaxed this assumption and then showed how their results would change as a result. So MM1, in this world at least, means capital structure does not matter. I'm sure the term MM1 rings a bell, and if it does, which I hope it does, then you may recall that there was also something called MM2. Actually, MM2 is an extension of MM1. Let me explain what that means. Look at this result. Value of the unlevered firm. Again, and now please pay attention because I'm about to introduce some important terminology, okay? What is an unlevered firm? An unlevered firm is one in which assets are funded entirely with equity. There is no debt by definition, okay? All right. If I asked you what is the value of these assets, by definition, I'm asking you what is the value of the unlevered firm. Now, value of the unlevered firm, and when I say value, I mean think enterprise value. I mean that's really what I'm talking about. Is what is the worth of these operating assets, if you can. Now, what would you do? You would say, well, you know, these assets are expected to generate some financial cash flows, and the rate at which I will discount them is the cost of equity. We just talked about it. Now, please recall, and this is why it's important to understand this stuff from previous modules. You may recall that assets have a beta called asset beta, equity has a beta called equity beta, and when assets are funded entirely with equity, asset beta equals equity beta. Remember that? The reason why I'm mentioning that is because if I ask you what is the cost of equity at this point, you will say, well, expected return on equity is the risk-free rate plus equity beta times market risk premium, right? This is the capital asset pricing model. In this particular situation, equity beta is exactly equal to asset beta, right? This is a unique situation where you have zero debt. You'll introduce a little bit more debt and this will change. But so I can substitute for equity beta asset beta. So risk-free rate plus asset beta into market risk premium. This cost of equity, this is a cost of equity, but I am going to denote that by the symbol R0, R0. This is referred to as the firm's unlevered cost of equity. Unlevered cost of equity. Unlevered cost of equity is cost of equity, don't get me wrong, but it is a very specific cost of equity. It is that cost of equity that exists when the firm has no debt, which is a very, very specific situation. And you can get this by plugging in asset beta into the capital asset pricing model. The assumption being that, well, not an assumption actually, because you can do that because in an all equity firm, the equity beta is in fact the asset beta. Okay, so R0 refers to the unlevered cost of equity. And the reason why I'm saying that is because if the firm is unlevered, then you take its expected cash flows and then you will discount them at 1 plus R0. And then subsequent cash flows, expected financial cash flows in year 2, you are going to discount that at 1 plus R0 square. so on and so forth, right? This is how you would find out the value of the unlevered firm. Okay, so that's fine. How about now we change the situation where we say, well, we're doing a pure capital structure decision. We're going to introduce some debt. So now we're going to take on some debt, and we're gonna right. So debt goes up, and we're going to buy back some of the equity. Nothing has changed on the asset side. Asset beta, of course, is still the same. But now if I ask you to value the same assets, you are no longer going to be able to say this is the value of the unlevered firm, right? Now the firm is levered. So what I'm really asking you is, what is the value of the levered firm? And notice, as I told you before, nothing has changed about the financial cash flows, remember? Debt doesn't change financial cash flows, remember? Because again, this is going back to module 2, financial cash flows are not influenced by interest expense. They're not influenced by how the assets are funded, right? So the cash flows are still the same. However, will you now discount these cash flows at unlevered cost of equity? I hope not, right? Because the firm is not unlevered anymore. It is levered, which means that there is going to be some cost of debt, and there is also going to be some cost of equity. And we know that in a situation like this, what do? We take a weighted average of the cost of debt and cost of equity. So in this case, the discount rate will be 1 plus whatever will be the resulting weighted average cost of capital from the cost of debt and cost of equity. And subsequent financial cash flows will be discounted at 1 plus WACC squared, so on and so forth, right? So this is what's going to be true. Now, I kind of talked about it before, but now I'm sort of formalizing this a little bit more, mathematically. Modigliani-Miller proposition number 1 says what? That, if you buy into the pizza argument, capital structure should not matter, which means that these two, they say, are equal. They're equal, right? This is the equal to sign. And these two equal means that this equation up here is the same. I mean, the value that you will get from this equation would be the same as the value that you would get from this equation. And because the numerator is the same in both, the numerator is the same, it's the same cash flows, then the only way you can arrive at the same answer is if, that's right, that the denominator is the same. In other words, R0 has to be equal to the weighted average cost of capital. R0 has to be the weighted average cost of capital. And, well, I'm going to electronically erase this. What that means is that R0, what is WACC? WACC is B over B plus S into the expected return on debt. And technically I should multiply this by 1 minus T, but we are in a world where there are no taxes, among other things, so I'm not going to do that right now. And then plus S over B plus S into the expected return on equity. So my main point is that MM1 implies, right, this is MM1, and MM1 implies basically this. This is implied by MM1. And if you rearrange this so that you express this is expected cost of equity. This is, I'm going to write as RS. Expectation sign, I'm assuming now, is already there. So cost of equity, if you do the math, it will solve out to R0 plus B over S into R0 minus RB. You can do the math. And some of you may recall this equation. This is exactly what MM2 is. What is MM2 saying? And this is the important point. MM2 is basically saying that as, when there is no leverage, okay, so that debt to equity is 0, then cost of equity is, of course, the unlevered cost of equity, right? Equity holders require a certain rate of return. Regardless of debt, they will be bearing the underlying business risk, and so they will require some compensation for that. And as leverage will go up, guess what? They're going to want a higher rate of return on their equity, right? Because they will not just be happy with what they were making in the absence of leverage, which is R0, but this extra bit they're going to require because of higher risk to them because of leverage. We've kind of said the same thing differently in a previous module. Remember? We kind of said it before. when debt goes up, when debt to equity ratio goes up, what does it do? It causes the equity beta to go up. And when equity beta goes up, guess what happens? Cost of equity goes up. We're saying the same thing. The only difference is that in this equation, we're saying it a little bit more directly, right? So in the previous module, we had something like, well, equity beta is 1 plus B over S into, asset beta. We had something like this. So we used to say, well, when there is no leverage, equity beta equals asset beta, all that fine. And when debt to equity is going to go up, cost of equity is going to go up, and therefore, equity beta is going to go up, and therefore cost of equity is going to go up. And actually, if you look at this equation, you have B over S here. We are saying that when B over S is going to go up, I don't need to first go and find out the impact on equity beta to then plug it into the capital asset pricing model. I can actually go straight to this equation and get the cost of equity directly. MM2 is no different from what you've seen before. And at an even more fundamental level, at an even more fundamental level, and this is the last thing that I'm going to say for this one. What it's saying is that, let's suppose that previously the firm was unlevered, right? So all the assets were funded with equity. And let's suppose that at that time, equity holders required something like, let's come up with a number. Let's suppose 15%. Okay, suppose. Right, so this was the unlevered cost of equity, and now the firm says, look, I'm going to take on some debt now, and I'm going to borrow some money, so debt is going to go up. Guess what? Debt is usually cheaper, isn't it? Right? Because equity holders are taking on a lot more risk. Debt is usually cheaper. Let's suppose you can get debt at like 10%. And let's suppose you're like, hey, why am I 100% equity financed? Right? So this is let's suppose if banks are offering, debt at 10%, why am I funding my assets, from investors who require 15%? Maybe I should, rather than being 100% equity financed, maybe I should drop down to 50% equity, and I'll fund 50% of my assets with debt. And guess what? 50% of my cost of debt will be cheaper. That's 10%. And then 50% will now be equity, and equity holders wanted 15%, right? So my cost of capital will decrease. Like, it's better than funding 100% with 15% at 15%. I'll just fund half my assets at 10% and half at 15%. Marty, Glenn, and Miller saying, yeah, good try, but no, because guess what's going to happen? 15% is what your equity holders required when the firm had no debt. When debt is going to go up, they're going to require 15% plus B over S into whatever that extra amount is. And guess what? If you do the math, in this case, it will amount to exactly 20%. Do you know why I know that's going to be 20%? Because 50% of 20% and 50% of 10% is going to give me the same cost of capital of 15% that existed before the firm took on leverage. And that's their point. That cost of capital will remain the same, and therefore the firms will be, whether you take leverage or whether you don't, doesn't matter. NPV of the assets will still be the same. And so that is, again, we'll sort of do this a little bit more, but that is the fundamental idea. MM1 and MM2 are not distinct ideas. MM1 begets MM2. And with that, I can show you, this slide right here. This is MM2 as you know it, and I just showed you how it comes about. Please understand the distinction between R0, RB, which is cost of debt, and most importantly, the distinction between R0 and RS. Both are cost of equity. Okay, please understand, both are cost of equity. However, this is a very specific cost of equity that exists if and only if the firm has no debt. RS is the general symbol we use to denote cost of equity in general, whether the firm has debt or not. And this is perhaps best illustrated using this diagram. If I measure on the horizontal axis debt to equity ratio, and on the vertical axis I'm measuring cost of capital. Okay, let's take it slow. This point right here, 0. This is when the firm has zero debt. Okay, zero debt, and therefore zero debt to equity ratio. It can borrow at a cheaper rate. In our example, this was 10%. But right now, if the firm has no debt, then its cost of equity is R0. R0 is this unique point here. It's this specific point. Okay. Now, somebody might say, well, why are you borrowing so much at this high cost? Why don't you borrow at this cheaper cost of debt? And so as we start to increase our debt to equity ratio so that we're borrowing a little bit more at, or rather, we're borrowing more at this cheaper rate. The problem is that MM2 says that cost of equity will start to increase, such that if you take a weighted average of this number, which is lower, but then this number, which is higher, you will arrive at the same number, which is exactly equal to the starting R0. So that this line here is the WACC equation. And it's a straight line, meaning that WACC remains at the level of R0. So please understand this distinction. R0 is this unique point, but WACC is this entire line because it's changing with, well, it's not changing, but it's, you know what I mean, like this corresponds to different levels of debt to equity ratio. And please understand this also, and this is also a graph that I like to draw at the same time. Oh, bad handwriting. Let me erase that and just start one more time. So if I am measuring debt to equity ratio again on the horizontal axis, but here I'm measuring firm value. Okay, not cost of capital, but firm value. Okay, when the firm has zero debt, the firm will have, or the assets will have some value. What is that value? We have referred to that as VU, value of the unlevered firm, because that is exactly what's true, right? There is no leverage right now. The firm is unlevered. As you're going to take on more and more debt, the firm is becoming what? Levered. However, in magnitude terms, that magnitude is the same as that of the unlevered firm. So VL is this line right here, corresponding to different levels of debt to equity. VU is this unique point. Value of the Modigliani-Miller proposition number 1 is this. Value of the levered firm is the same as the value of the unlevered firm. What I want you to appreciate is saying this is the same as saying this. They're two sides of the same coin, right? Saying that capital structure does not change WACC is the same thing as saying capital structure does not influence value. Capital structure does not influence value is the same thing as saying capital structure does not change WACC. They're both two sides of the same coin. Anytime that will change, if we end up saying for some reason that capital structure changes result in a lower WACC, as WACC will start to fall, if it does, we'll see conditions under which it will, that would be the same thing as saying, oh, value is increasing. And whenever WACC will start to increase, and we'll see when it can, we'll see that happens when we start relaxing some of the assumptions that Modigliani-Miller made, when that would be the same thing as saying that value is decreasing. So both of these are two sides of the exact same coin. Remember that. Okay. So enough on this. We'll pick it up from here the next time. I'll see you guys.